On today's show, 3 questions. Number 1, what's up with oil? Number 2, is the stock market too big to fail? And number 3, what's the secret to enjoying work?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Yeah, you are. Dream team. We're here.
What's up?
We're just talking dog days of summer, guys. Do we have anything to talk about today? For real?
Nope.
Yeah.
Thank you all for listening. We'll see you next week.
Thank you, guys. Have a good one. No, we have to tell people this. Rabih, we would joke around with you because when we get into this stage of summer, we talk a lot about 2 cents and prep and all this stuff. And the last month, you've been like, Matt, I have nothing to talk about. There's nothing going on in the market. And then we talk for 45 minutes somehow.
Yeah.
So, but Jake, you were saying that it's kind of just even everywhere. There hasn't been a ton going on. It's kind of been quiet.
Yeah, well, this is always a tough time of year for me because July and August are the no sports months of the year, right? These are 2 where there's not a lot going on. And so this is when I have to spend time with my family, unfortunately, is the other option.
Unfortunately. My God.
You've got the World Cup this year. It's fine.
Okay, first of all, I'm going to stop us right here. We've made a push and a commitment to talk less about sports. We have to get more eclectic in our interest, guys.
Yep.
And so we need to shift to something else.
I think the World Cup is the exception. I think the World Cup has transcended regular sports. It's like a once every 4 years thing. Like the average Joe is somewhat interested in the World Cup.
I think so too. There are crossovers for sure.
And this is the only episode remaining that coincides with the World Cup. So what are your predictions, Argentina or Spain, for the final?
Spain. Give me Spain.
Probably Spain. But guys, we just said this. We just said we're not going to talk about sports.
Okay.
We just said.
We just got our predictions out there so people can make fun of us if we're wrong.
Let's mix it up really quick. What shows are we watching right now? Let's hit that real quick. What shows are we watching?
The World Cup.
I went.
Rabih, you're out.
Quick pivot. I saw The Odyssey last night.
Oh, what'd you think?
Incredible. It's a spectacle, huge. Again, I got home at 1 a.m. So
Does Christopher Nolan really miss? Does he ever miss?
No, I think he's pretty awesome. I think he's the director of the 21st century. He is just incredible. It was awesome. I'm not very familiar with The Odyssey. Didn't really know much going in. It's a 3-hour movie. It's huge. I saw it in IMAX. It's cool. I would recommend anyone to go see it.
Okay,
really
I'm in. Have you seen the previews for Rocky?
I
Play Rocky.
I have.
It looks so good. I am so in. I've not been this excited about a movie for a while. I hope it doesn't disappoint, but it looks incredible. It looks incredible.
Yeah. It's a cool story too, I think. I know a little bit about the story.
Amazing true story. Yeah. Okay, Rabih, other than World Cup, what are we doing on our free time?
I'm watching other stuff, like Lebanese stuff, not American. And I'm watching Lebanese basketball because it's the final. It's the sports season.
We cannot talk about sports, Rabih. Okay, we're moving
Lebanese stuff.
Lebanese. Wow. I love this. I have watched a Lebanese basketball game with Rabih, and it was enjoyable. I liked it.
Wow. Okay.
The passion. Okay. Well, before we move forward, this show is brought to you by Dentist Advisors, dental-specific financial planning and tax and accounting firm. You guessed it, just for dentists all over the country. Our sole focus is on helping dentists make work optional sooner. One of the things that we do, as I'm sure you can tell from our content, a ton of education. We have the Launchpad coming out again. September 17th is the first day of our second cohort, 8-week live course taught by all of us here, and along with our other dental-specific advisors, and then we bring in people from the outside as well. You can check it out at dentistmoneylaunchpad.com. Okay, let's jump in. Rabih, what's up with oil?
What's up with oil? Did you guys go to the gas stations and try to fill your cars now before it's climbing back up?
I literally just drove to the office this morning. My car is down to 35 miles left. I'm pushing it to the limits here, like Kramer from Seinfeld. But I have not. I need to fill it up probably today or tomorrow. Yeah.
You probably have to fill it up sooner or later, simply because oil prices have been going back up now that the scrimmage / war / we really don't know what's going on thing is happening between Iran and USA. Oil prices during like at the, I would say, the most intense phase of the fighting reached all the way up to like $115 for Brent. And then by the beginning of this month, on like July 1st or 2nd, when there was this treaty that supposedly ended everything, oil prices actually dramatically went down all the way to $68. As of now, as of we speak, they're at 82. Say they climbed back up a lot just in the last 2 weeks. However, because oil has dropped from a high of 115 all the way down to 68, and it stayed for probably a month, we were able to collect some economic data that showed what of an impact oil had on the economy just by it dropping. And the two main data points that we collected were inflation and consumer confidence, which showed up today. So I'm going to start with inflation for you guys. And for inflation, what has happened is that inflation, as we measure it with CPI, has been increasing for 5 months in a row. And last month was the first time we see a change in that trend. So just to give you some numbers to as a baseline, in February, the year-over-year inflation, the CPI, the one that you read on the newspaper, was 2.4. In March, it climbed to 3.3. In April, 3.8. In May, 4.2. So in 4 months, we moved from a 2.4% annual inflation to 4.2, kind of doubled. And then in June, we dropped back down from 4.2 to 3.5. And the main impact for why inflation dropped from 4.2 to 3.5 was that oil dropped from that 115 down to the $68, which is good because when that piece of data was released earlier in the year, we had a really good day on markets, whether it was fixed income because interest rates went down, or whether it was equities because the stock market welcomed the news, right? So the biggest impact of lower oil prices was that all financial assets actually increased on the news because inflation dropped down. And the other point, or do you guys want to say anything about inflation before I move to consumer confidence?
Jake?
I don't know. Not really. Yeah, like you say, creeping up a little bit higher. I feel like I've... No, sorry. I don't have much to say. That's great. I just said nothing there. Just flat out. I don't have anything to say about it. I've thought about a few different things, but I've said them, I feel like, a million times on this podcast. I'm good. Inflation sucks.
His initial thought was, I have nothing to say. Then he was going to say something, but I already said I have nothing to say.
Continue to say nothing for the next minute.
I like it. I've got nothing either, Rabih.
Okay. So unlike you two who don't have a confidence in their answer, the U.S. consumer confidence has a different story. So we've been having a slump in consumer confidence. Like in February, we're 56 points, which above 50 means positive, below 50 is negative, and then you look at the trend. February, we're 56 points, March, 53 points, April, 49 points, and then May, 44 points. That, honestly, you can see it. Like when inflation was the highest, consumer confidence was the lowest. And then in June, we started recovering back up to 49. And then July numbers, which already are coming in, 54 points. So consumer confidence have been going up. Inflation has been going down, but this is only a reading over a span of a month or a month and a half. And all that, but the significance of it is because we changed the direction. Suddenly, inflation is coming back down. Suddenly, we are becoming more confident in the economy. But it has been short-lived. And the reason it's been short-lived is because oil prices are now back up and the war is happening again. The oil prices are back up because of the war. So what is the impact of that oil movement in the summary? If we zoom out and look back at it, it seems like the market has signaled over the last month and a half that lower oil prices are beneficial on multiple fronts. Inflation on the first hand and consumer confidence on the second hand, which also will make the job of the new Fed less complicated. Will higher oil prices within round 2 of this war be helpful? The market is signaling that it's not, and we're seeing that it has flattened. We haven't really moved over this month. We're just up and down, but on an aggregate term, we haven't really moved. So yeah, oil prices are kind of the key of where we're going to revolve over the next couple of weeks, especially that this is the only piece of news that's coming in terms of economic data for the market to crunch.
Yeah, I mean, and we hate inflation, but we've said this so many times. It's not changing behavior. And until it does that, it doesn't really matter, right? I
Yeah.
mean, in the sense of like economic data, it's not. We haven't seen a change in behavior for a long time now when it comes to spending.
Yes. Honestly, with that consumer confidence data, something that is very interesting, if I ask you what is your expectations for inflation for next year and what is your long run expectations for inflation, what do you think they are? This is not what the market thinks, what consumers think. The Fed always says we want to target 2% inflation on the long run. You guys know from this consumer confidence survey what people are expecting inflation to be next year and what the long run might be?
The most recent reading, you're saying?
Yes. Like if I ask you, what do you think inflation is going to be at next year, given that now we're at 3.9?
Me personally, I would say it's going to be lower.
Okay, interesting.
Just because I'm maybe more of a pessimistic outlook on the next 12 to 18 months. And I wonder if we're going to keep increasing rates and getting less money in the economy and trying to really get that inflation number down. I don't know. That would be my personal take on it.
Yeah,
I would literally have no idea. I have no like even like direction of what I would say. It's been so hard to predict these things.
Yeah. So the average consumer, right, is not looking at data and trying to understand how the economies work. The behavioral aspects kind of take over, and recency bias kind of influences the expectations of the average consumer. And according to this last survey that they did, 1 year inflation expectations are at 4.2%, which eased from 4.6. So like the average Joe is thinking that inflation next year is also going to be 4%, which is wild. And then long run inflation expectations from the survey is saying that it's holding steady at 3.3%. It should be 2. So this is telling you that consumers are now expecting that prices are going to be continuing to increase, which is going to influence their decisions about big purchases, because if they're going to be getting more expensive, I may spend right now. And it's also going to alter their decisions on how they ask for raises or how they find a job. So until something big happens that resets the expectations of the uninformed investor, the consumer behavior is indicating that, we might think inflation is here to stay for a while.
Yeah, just keep continuing to do it. Jake, anything else? Any thoughts?
No, I think that's a reasonable assumption by the average consumer there. Sure.
What's going on, Rabih, with Iran, and when's this going to be over? I need a prediction.
I have no clue, but what happened? Honestly, if you think of it, like if you wanted to find the war ended as whoever is participating in that war got what they wanted out of it, whether it was military wins or political wins or etc. That memorandum of understanding that was signed between the U.S. and Iran, and the one that's being signed between like Israel and Lebanon, etc. It did not end or distribute the winnings or losses. What it said is like, we're going to change the game from being purely military to both military and political. So now there's political negotiations happening, just like military negotiations happen or like get translated on the battlefield. So what happened is that the war didn't end. No, it's still going. What happened is now it has multiple channels to it. A political route and a military route. And when one fades, the other amplifies, and what other amplifies, the other fades. And they're in tandem and they're dancing. It's just adding more complexity. But if you think of it, neither side has achieved what they wanted to achieve yet. Oil prices are kind of the thing that hurts everyone. So that's the one that they're trying to agree to keep in balance. But now oil has jumped from 68 to 84. So we'll see how that trickles back on how both parties make decisions.
Yeah, I'm surprised. I'm surprised that we haven't seen a bigger reaction in the market. I mean, these, like you said, these ceasefires. I mean, these ceasefires are lasting as long as my morning runs, which is not very long, we'll say. So it's just, but maybe we're just already so numb to it. Like there's so much crap. It's like everything nowadays. It's just there's so much coming out. We just become numb. Like we don't even care anymore. It's just interesting. I don't even know what's happening because again, every day it's something different. We've ceasefire. We fixed it. No, never mind. We haven't. Now we're back at war. It's shocking to me that the market's not like the market has been pretty flat based on it, which is surprising to me.
This kind of bleeds into my question, Matt, if we just want to get into it. Kind of what you're saying, like the market's reaction to this year. I don't know if Rabih's finished here.
Rabih, any other thoughts?
Nope. Perfect.
Yeah, so it leads right into the second, which is just the stock market being too big to fail. Let's jinx this thing, Rob.
Yeah, this might be, let's just big flashing warning signs as we're talking about this. This is
the top.
This could be the top of the market with what I'm about to talk about here.
Kidding. Okay. We're kidding.
Essentially, going back to this, is the market too big to fail? We haven't seen huge stock market reactions from some of these political events and things. I saw some stats from Citadel, produced a survey here, talking about retail investors and how much they're investing currently. And essentially, retail investors, which are average individual investors, right, not big institutions, are deploying capital at a record pace. I think they came out and said that June is on track to become the strongest month in history, with daily purchases of stocks nearly 4 times last year's averages. Essentially, in layman's terms, people are buying stocks and ETFs at a record pace, and that number just keeps going up and up and up. There's probably this has to do with a lot of things here, of maybe people on social media and so much financial content, and maybe we're expanding financial literacy, or younger people are getting more involved in the stock market. But essentially, we're seeing record inflows into stocks and ETFs, even sometimes options, futures, things like that, maybe stuff that we don't approve of as much. But just a ton of people are getting invested in the stock market. Enough so that, let me share this for those listeners on YouTube. I want to share my screen with you guys too here. Can you guys see this here? This tweet from Joe Weisenthal here, where he showed percentage. Oh no, I don't have an X account, so it's not going to let me make this bigger. But percentage of household net worth in these different asset classes, essentially cash, real estate, and equities. And as you can see from this graph, equities have now taken the top spot over real estate as a percentage of household net worth. Essentially, a little under 35% is kind of where we're ending up here. As you can see on this graph as well, this has never really, the last time this happened where equities were a bigger percentage of net worth than real estate was back in 1970, was the biggest sustained time where that was the case. And that has not been the case up until recently.
And then look at that massive dip from 1970 on for a while.
Yes, huge dip. And then we've really been rising since 2000 on the equity front here, where just more and more people are getting in the stock market, more and more people are investing.
Which makes sense. The barrier to entry has only gone down since 2000.
And maybe on the opposite end too, Matt, maybe the barrier to entry for real estate is getting bigger.
Yeah.
And larger recently, right? Maybe why we're seeing some of this tumble down here on this real estate is less and less people are getting into real estate. Maybe they're funneling more of those dollars into the stock market. All of this, I thought this was a pretty fascinating development, because most of the time we've talked about how real estate and people's homes are usually the backbone of most people's net worth. We may be seeing a flip there or a change here. We'll see how this data plays out. Yeah. But what this brought my mind to is that is the stock market, with more people getting involved, is the stock market getting so big that essentially we have not seen a prolonged dip in the stock market for quite some time now, right, Rob? I mean, we had 2022 where we had a downswing in equities. We had COVID, which was more like a crazy pandemic, and the market was down for less than a year or two, and it kind of recovered all within a year. We have not seen a prolonged recession correction in the market really since 08, 09. Right?
I don't like this conversation.
Takes years to recover.
I don't like it.
My question I'm posing to you two is, have we gotten to the point where we are paying so much attention to the stock market and the administration is paying attention to it? Are the days of year-long prolonged downswing, years-long downswings over? Is that a crazy thing to say?
So I've got thoughts, but really quick, I want to highlight something you said earlier about this the separation of now equities versus real estate.
Yeah.
I think the other factor that's worth pointing out, which is what we've talked about on the show quite a bit, is, you said it, the barrier to entry. The cost of first-time home buyers is just so astronomical now that I think these young people are starting to pivot and just say, well, if I can't buy a home, I'm going to go invest. I think it's kind of a confluence of all these things, but I think that's a pretty easy, not even a leap, an easy step to take, to look at and say, well, yeah, they're just investing in something that's easier to invest in now. They can't afford a home.
Yeah.
So to your second point, I'll just keep going, Rabih. I want to get your thoughts, but my answer is absolutely not.
Okay, good.
Because no, there's no way. And I'll say this simply, and then I'll let Rabih say it way better. The market might change. Humans never do. And as long as humans are involved in this big ecosystem, we will always have emotions. We'll always have something that creates these cycles. So, Rabih, to you.
I'm with Matt on this one, Jake. I'm sorry.
Okay, that's great.
But yeah, first of all, I want to comment on that chart that you showed, especially with the drop in equities. This does not mean that equities were going down or they were losing. This chart shows you how each one of us distributes their wealth. How much of your wealth is in equities? How much of it in real estate? How much in cash? And when there was a shift where real estate was going up and equities were going down, that was because people were choosing to buy more houses. And that was in the 60s and 70s, where the idea of the American dream was much more vivid in terms of purchase your own house than it is right now, right? And the barrier of entry that Matt talked about is definitely there. It's just this is an allocation decision. Which one is sexier for people right now? And stocks are definitely sexier than houses. This is all what this says. This does not mean that there's one asset class that is performing better than the other. Actually, if you go back to the chart and you see in the 1970s how cash went up, that's because cash was earning 16% at that point. Interest rates were 16%. So people allocated a little bit more to it. So it's an allocation decision, not a performance-based decision. But what this tells me, that chart, for me, is very optimistic, because this is aggregating the allocation for all Americans, regardless of where they stand in the net worth hierarchy. If you look at this exact same chart, but you look for the bottom 20% or the middle 50% or the top 20% of Americans, it completely shifts. The bottom 80%, I would say, of Americans, a big portion of their net worth is in their house. The top 20% of Americans, the biggest portion of their net worth is in financial instruments, including stocks. So the fact that now stocks are making more portion of our wallets than they used to, it means that more and more Americans are having the lifestyle or the saving behavior or the allocation of behavior that the rich do. So if anything, this chart's telling us from the year 2000 until today, we are becoming richer as a country, as individuals themselves. So I find that chart highly optimistic, by the way.
Me
I
too.
think it's awesome. We always tell people, like, save more money, invest more money. Again, historically speaking, stocks are going to appreciate at a much higher rate than real estate, right? In general, on average. I know the last
it's a signal of progress.
Crazy. Yeah, signal of progress there. I'm just asking the question where we have not seen a prolonged downturn. Sorry, knock on wood, wherever you are, in a long time. I just wonder, we always say the economy and the stock market are two separate things. I wonder, are they converging a little bit more here, where it seems like the stock market, we are so hyper aware of it now, and no one wants to see any dips in their portfolio, including politicians who make decisions about some of this stuff. Or it's like, are we so hesitant to enter into recessions or have any dip in the stock market that even if we do get some headwinds, are we going to see a COVID situation where we just pump money and try and fix the situation as soon as possible? I don't know.
Yeah. Really quick, Rabih. So there is truth to this in the sense of, if you look at the data, like 19th century history of market downturns and the frequency of things pre-creation of the Fed, absolutely, there was a lot more, there was less regulation. We were still kind of figuring out this whole market thing in the late 1800s, early 1900s. And there's a lot more frequent downturns and a ton more volatility. Pretty much post the Great Depression and then on, it's become further in
more
the frequency, more stability and less frequent massive downturns. So I think that bears out in the data. But to say, I don't know if that extrapolates out to we'll never see another. We will see another one.
Of course,
we will.
Yeah.
We will.
Are they becoming quicker though? Is an interesting thing. Are we going to have times where we get a huge 30% drop in the market, but it recovers within a year or two? Are these things happening quicker? The downswings are happening quicker, but then the upswings are also happening quicker
faster.
because of
We're
technology.
seeing that too.
I don't know.
Yeah.
Maybe.
Rabih, what do you think?
Yeah, no, I think all of that is correct. Systematically, the infrastructure, the pipelines that support the stock market have changed. We moved from a pension-based economy to defined contribution plans economy. Like now, everyone depends on their 401k to retire.
And Trump accounts, of course. Trump accounts.
Trump accounts. That is immediately funneling into the stock market. So now it has a constant stream of money coming in, regardless of what the economy is doing and the stock market is doing. But I think it's important to differentiate between a drop in stock prices because the stock market is not functioning as it's supposed to versus a drop in stock prices because the economy has taken a hit. It is academically proven that we have become much better at making sure the economy doesn't take a hit, Jake. And this is why the frequencies of drop, those prolonged drops has been lower. The last big recession we faced was 2008, right? We had a little bit of weakening in the economy in 2015, 2016. And then the COVID one was avoided with big bailouts, right?
Yeah.
But the economy itself hasn't been dropping. The economy has been doing well. But the stock market, on the other hand, has been seeing a normal amount of drawdowns similar to what it has done I would say, the 21st century. In 2022, we had a 22% drop in stock prices.
I know.
It didn't happen with a panic. It was a way that the economy was reorganizing itself.
Which is actually kind of shocking, by
and
the
we
way.
recovered pretty quickly. I think is like in all of these recent drop downs, year. But like 08, 09, it was like 3 years before getting back to normal prices. Like really, multiple years. We haven't seen that in a while. And we probably are going to get one now because of this podcast is going to change the universe too. So it's coming for us. But it's something I was thinking about. It just seems like we are as confident in the stock market as ever. More people are putting money in than ever. Most people have access and like exposure to the market.
Well, and to be fair, 08-09 situation based on history doesn't happen that often. Like that is a like we say this, the data shows, intra-year decline of 10% per year is pretty normal, 20% about every 3 to 5. 30 to 40, we're talking like decades between these types of things.
Usually about a decade. It's like 10 to 12 years.
Probably 10, 20
We're kind of a
years.
little past due, essentially, like from that point.
I see what you're doing here.
I'm just having a fun time on the podcast, guys. Stock market gods do not come after us. And we've loved Jake, the returns the past couple of years. We've loved the returns. Keep them going.
When that happens, what are you going to tell your clients? We were due for one?
Yeah,
say this is an awesome time to buy. Let's do it. Let's get in during this downturn.
Here's one thing I'll say really quick, and maybe I'm thinking about this too simple, is I hope this is not the case because it is a truism and a law of life that you do not make progress without pain. That is just a truism of life. Yeah. And so if we get to a place, if we truly, this is why I just don't think it's possible, because we can't get to a place where this is the case, where we don't ever have any pain, because then it would be synthetic. It would be fake. It wouldn't be natural. So that's where I'm like, no, it's an ironclad law of life that there is no progress without some level of pain. That's how it is achieved. And the pain of the stock market is that uncertainty and is the fact that we are going to have these downturns. They're features. They're not bugs. And so that there's just no way, because humans don't ever change.
I do agree with you guys. I do agree. But I'm curious on it.
Start the freaking clock.
I've actually had a lot of conversations with clients about this where we're reviewing portfolios and it's been like the greatest 3.5 years ever. And they're like, is this going to keep going? And I'm like, I don't know.
Yeah.
Maybe we're just, who knows?
I truly do remind my clients when we do that, we have those reviews. I'm like, you do not get these 3-year runs without enduring the years that it's not like this. Like, you just have to remember that. And whenever we're reviewing, I'm like, I tell them it will not always be like this. You just have to know that this is part of the process. So I try to remind him in those moments that when it's really great, it's like, this is not. So next time when we're talking, or one of the times we're talking and it's not great, it's like, hey, remember that last time we had that 3.5 year amazing run? And like, this is all part of that journey and that cycle. So,
well, if anything, maybe this is just a good level set for all those retail investors who are pouring money into stocks, which is great. You should be doing.
I think it's great.
We're not going to have, maybe the past 3 years is not going to continue into perpetuity.
Yeah. Well, and sorry, Jake, you said that. It's a really good point. This is how I also know it's not going to be how it will always continue.
Because everyone's getting in now.
Yeah, well, no, but because those are all new investors that haven't felt the pain of what actually a downturn looks like. And so they don't know how to respond. Like, you just have this new batch of investors coming in that's going to act the same as the old ones did. And it's just going to continue
there's
the
probably
cycle.
a whole generation of investors who have never really felt market pain.
Exactly. And they're going to react the same way that every human does. They're not rational actors. They're going to freak out at some point. It's going to create a downward cycle. We've been seeing this since the 1600s with the tulip, the tulip. And I'm not saying we're in that phase, by the way, but cycles will continue for sure. Rabih, where are we wrong?
No, I agree with you, but I don't think that it's due. We are at the cusp of
let's keep it going.
Of harvesting the productivity gains and the cost cutting and the efficiency and the scalability of a new revolutionary technology. The biggest threat right now is bubbles created from overinvestment. But I don't think we are
like AI.
Exactly. Yeah, I'm talking about AI, but I don't think we're at a point where, we do not know how we can grow ourselves out of the problems we're in. We're in a recession. It's going to be just, we can't keep ourselves in check, and we're spending money irrationally, and the market is punishing it for us. So if we do it right, that bull markets stay for 8 to 12 years. If 2022 was the beginning, 2023 was the beginning of this bull market, we're only 3 years into it.
That's a good point. It's a good point. It doesn't feel like that. And this is what's so amazing to me is 2022, what was it, 2022? Yeah, we had a 20% drop without the panic, which is so rare. But I think we've forgotten that. So we have started a new bull market post 2022. So that's a great point, Rabih. We could easily see another 4 or 5 years of this. That wouldn't be that crazy, I don't think. I'm not saying we will. Yeah. But I think we are thinking, Jake, you said it, like, 0809 was the last huge panic.
Just prolonged.
Prolonged panic.
Prolonged downturn,
Yes. But I think 2008, 2009 was more akin to Great Depression levels. I'm not saying it was the same, but it's in the same category, which I don't think those happen. We're talking 80 to 100 years.
Sure.
More so for that. If we're looking at a traditional recession or downturn or pullback, 2022. So I agree with Rabih. It's like we could easily see this for another 3-4 more years.
So I guess
despite
the point
what you're trying to say, Jake, despite what you're trying to
I guess the point is keep buying stocks. They're great. They perform really well. Stocks. Keep buying. Good job, all of you retail investors pumping money in. Let's keep it going.
What is Jake's shorting something? He's shorting.
He has multiple puts on.
There's a short
NASDAQ.
Position on something, and he's using the influence of 2 cents to get people to sell.
That is not.
I love it. Yeah, I love it.
Anyway,
and last thing we need to say on this: the question was, is the stock market too big to fail? I do think we need to spend 1 second on that. The answer to that, in my mind, is. Yes, it will not fail. The global market is not going to fail in the sense of like what we'd say failure is. Those are two very different things.
Yes, we are talking about volatility and market downswings, and not that the stock market's going to go away and your portfolio is going to drop 80% and peter out.
Yeah, because we always try to remind people of this. Like a bet in the stock market is a bet on human innovation and progress and people continuing to wake up every day and better their lives. Like that will never stop until it does, the world's over. It's like, then who cares? Your 401k doesn't mean anything. So it's not going to fail in that sense. Anything else, Rabih or Jake? Any other words on that? Feeling good? All right. We have no pivot to this next one. It's completely off topic, but it's unique.
Enough stock market talk.
Enough stock market talk. Yeah. No sports, no stock market. I thought this was interesting. So I came across this article from Psychology Today. And so I found it in a newsletter that I read. And the topic is, what's the secret to enjoying work more? And I thought this was interesting on a couple levels, not only for the dentist that listens to this, for them, for themselves, but most importantly for their staff. This is such a pertinent topic we hear all the time from, we're talking to dentists all the time about, especially something shifted. I mean, I've seen this in our own team. I've seen this with dentists. Something shifted in COVID, and I don't know if it's ever gone back. And I'm not saying it's all good or bad, I'm not saying anything like that. It's just something shifted in the workforce, in mindsets and approaches. And I think dentists have felt that as well. So I thought this was super interesting. So, I guess I'll stop there. Do you guys feel the same, that something has shifted post-COVID?
Yes. And I'm going to say the positive, just in case your list has negatives, is that the U.S. economy on aggregate has been on an upward trend or being more and more productive since COVID. We've become more productive as a nation since then. You can, there are other reasons of the impact of COVID, but I think on an aggregate level, the big title has been, we have become more productive.
Yeah.
Yeah, I
Jake,
think
go ahead.
COVID changed work forever. It really did. I would be curious to hear your guys' specifics on how it's changed. I think I'm a little less clear in my mind of what some of those positive, negative, whatever the changes are. But yes, I definitely feel like COVID was a shift in how we work and think about work.
Yeah, I agree. I don't have data behind this. Rabih's got more data on the productivity. I
Yeah.
do think post-COVID, as Rabih has pointed out, as an economy, we become more productive. The proof is in the data. So that is totally true. I think generally speaking, and I'm not saying this is necessarily, I don't know. I don't have an opinion of like, is this good or bad? But I do think there is something where we're less connected at work, or we're looking for less connection at work, human to human connection, or building our social structures at work. I think that I've experienced that, we've experienced that, I think, and I think a lot of people out there in general in the economy. I'm not saying that's good or bad. I just think that's an observation that we're seeking less connection at work. It's not, we're not looking for that like social capital at work as much.
Yeah, I think where it used to be primarily a place where you were going to work bright and early and you're leaving work pretty late and you're spending the majority of your day there, it is like it was your entire social structure.
Yep.
And you're maybe a reason for it being.
And we were probably less productive in those settings, but more connected.
And now there's this change where there's work from home and hybrid work, and even people who are still having people come into the office have different, like, I think even different structures around how you're working at different times. And it's shifted to more of work being more of a part of my life, something that fits into being my entire life for maybe a lot of people. And there's probably positive and negative consequences of that. But yeah, I agree with you.
Yeah. Someone asked me on the team the other day, I'm highlighting, this is a me problem. But I do think there is something to this post-COVID. Someone asked me on the team, we were going to lunch, and they said, Rabih, actually, it might have been you. We were talking about a client situation, and we were just talking about it. And I think it was you, Rabih, or someone said, do you ever disconnect from this stuff? We're at home. And my answer is almost never. Like, I'm almost never disconnected from work. Now, this is a personality flaw of mine, but it's become harder post-COVID.
I think that's why productivity's gone up for a lot of people. It's because we're home and working, and we have our computers and emails and laptops, and work just bleeds into life, and we're probably even working a little bit more sometimes.
Yep. It's like before, you go to, like, to your point, Jake, you go to work, you work your day, you go home, you're disconnected because you actually are, there's no way to connect to you. Now I'm getting texts, I'm getting emails, I'm getting Slacks all the time. And I'm always checking, I'm always looking. And it's like in these intermittent spurts where I work a lot more, but spread out and interwoven into my life, to your point, Jake. So that was a side quest. I just thought we would highlight some of these things. Here's what the study shows. So there was a recent review of 1,192 studies spanning over 35 years of workplace research. And what they were trying to examine was what helps people thrive at work. And what I like about this is if I asked you guys, what do workers want more of? I think the surface level answer, the easy answer, I'm guessing you guys are thinking, and I'll just say it, would be money. And I think dentists get into this mindset of like, oh, I got to pay them more. Which I'm not saying you shouldn't be thinking about that. Like, that's neither here nor there. But this is interesting because it talks about nothing about money. So I'll summarize this really quick, and then we can go one by one. So their research showed three basic psychological needs: autonomy, competence, and relatedness. So I'll read more specifically what those all mean. So number one, autonomy. Feeling like you have some level of choice. So it doesn't mean you work without rules or doing whatever you want. It means you have a feeling that you are doing things because you want to do them. You experience volition, choice, and feeling authentic in your behavior. So when people feel pressured, micromanaged, constantly monitored, motivation tends to deteriorate because their need for autonomy is being undermined. In contrast, workers who feel trusted and given meaningful choices are more likely to experience higher quality motivation and better well-being. I'll stop there. Do you guys have thoughts on the autonomy topic there?
I agree. Yeah.
Go ahead.
I was like,
no, go ahead.
What's the alternative? The alternative is slavery. Like, you're just told exactly what to do. There's no alternative to this.
Yep. Yeah. I think a general rule here, like what I found, and I'm nowhere perfect with this. This is constant effort, but the kind of a general philosophy is like treat people like adults and they'll act like adults. And when they don't, you address it. But I think for the most part, you trust people, you try to give them some direction, but then trust them to do their thing. Again, easier said than done. Number 2, competence. Sorry, Jake, did you have anything to add to autonomy?
No.
Okay.
Good.
Number 2, competence, feeling capable and effective. So most of us want to feel that we are good at what we do. This is kind of what Daniel Pink talks about in his book Drive. He talks about mastery, but also build. Good at what we do, and also build our skills through work. So people thrive when they have opportunities to learn, develop skills, receive useful feedback, and experience mastery. Conversely, when work is confusing and impossible, provides little opportunity for growth, motivation suffers. Because competence is not about being perfect; it's about making progress, feeling capable, and meeting challenges. Any thoughts on this?
I think this is a pretty big one. I just feel this personally. I think most of us like the idea of getting better at something, progressing at something. Like, I think we get huge satisfaction from feeling like I am better at my job today than I was a year ago. And I hope to be better at it a year from now. And to feel like there is like a ladder or something you're climbing in your career to get better at, I think it's incredibly rewarding. It's kind of, it goes back to the autonomy one too, like having control over some of what you do and things that you're getting out of your job. But that's very different than like you're just punching in, punching out, and it's the same single thing every day, and I don't feel like I'm getting better. I get a lot of satisfaction about feeling like I'm getting better at my job.
I agree. We always need something to work on. Rabih, what about you?
Yeah, it's the middle, golden middle between what you're doing irrelevant and doesn't, even if you achieve it, you don't get any sense of purpose out of it. And on the other side, the other extremes, like it's an impossible problem and you're gonna be never gonna get a feeling of reward. So it closes the feedback loop to keep you motivated to go back at it. So it has to be somewhere in between.
Yeah, I agree. And this is on the dentist. This is on the leader to be able to help the team know what does it mean to get better. Like how do you even track that? I think that's a big effort there. Last one, relatedness. So feeling connected, kind of what we talked about. I think this one suffers probably a little bit more depending on the group. But people often say they quit managers, not organizations. Oh, that it hurts. And and they stay for the people, not the job. Research suggests something even broader. We need meaningful connections with others at work. Supportive colleagues, managers who listen, a sense of belonging, all contribute to motivation and well-being. Even brief moments of genuine support can make a difference. The finding has become especially important in remote and hybrid work environments. I promise you I had not read each of these before we talked. Where workers have greater flexibility but fewer opportunities for meaningful connection. It's exactly what we were saying. More productivity, less connection. Final thoughts on this, guys, on the relatedness piece.
I think we all understand this. Who you work with is so important. It's crazy. Like in my meetings with clients, I'm even most of this happens with non-dentists. I'm usually talking to practice owners and they have some sense of their team, but it's usually the spouses who are working and they either tell me they love their job or they hate their job. And I always ask them like, why? And the first thing they say is like, I just don't like the people I work with, or I really love the people I work with is usually the first thing where it's like, oh, this manager stinks or whatever. It is amazing to me. It's how often just like a job can be awesome or pretty crappy solely based on not even just managers, but your coworkers who you're working with has such a big impact.
Yeah, it's huge. Rabih, what about you? Any thoughts?
I have thoughts. I don't think there's a right answer. It's just a reflection of which values you prioritize. But if I wanted to ask you which regime would you rather be in? The pre-COVID regime of more connectivity, less productivity, or the post-COVID regime, more productivity, less connectivity? Which one would you prefer personally?
The post
Jake?
guy. I am a big flexibility, autonomy person in my work. That is probably like what I value the most, maybe second to money. I think we all first work for money, but autonomy is huge for me. And I love the autonomy that COVID has brought, even if there's some challenges that come with figuring out how to do autonomy right. I love it.
I like the direction we're headed post. I still think we have to reshape some things generally from my perspective. And I think there's pros and cons that Jake said. I think we are what the middle ground we're trying to find. So I like where we're headed with it. I think COVID was a nice wake up call for a lot of wasteful work, a lot of pointless work, and it's forced us to re-examine how we look at work, which I think is good. But I think we had a whiplash then, and I think we're kind of trying to come back to the middle. So I think generally speaking, I like where we're headed with it. For sure.
Rabih, what about you?
I value freedom and autonomy more than other stuff in life, so I like it. But I also agree with what Matt is saying. Like, at what expense? There are some communal ties that we need to make sure they stay rigid and in place to allow us to move forward as a society, rather than become very fragmented. Yep.
Yeah.
Or just even like it's this crazy thing of like complete autonomy is probably a bad. There needs to be some restraints on autonomy too, right? Some rules or parameters in place, and I think
Some
we're figuring
constraints,
we're figuring that out as companies in a society. Yeah.
Yeah, I think there's a needle to thread here. It's tough. Like I've said this for a long time. You guys have heard me say this whole cliche of like, we're a family. No, we're not. We all have our own families. I think that's a corporate bullcrap cliche line when people say that. However, we are not fully independent, autonomous creatures all working in isolation. Like we're somewhere in the middle. And I do think, I've said this many times, a team that can be rowing in the same direction, working together with a unified quest or mission that we all kind of like can be motivated by, it's critical. It's huge. And I think it definitely serves part of this like fulfillment type part for workers. But it's a hard needle to thread. That is tough to find that middle ground of like, guys, we're building something bigger than ourselves. Let's like get motivated, but we're also not a family. Like it's hard. It's a constant process.
Yep.
So we all have a better inside view of like that approach we all try to take, and it's tough. It's something we're constantly working on. So anything else, guys, on this? I just thought it was kind of interesting to review. Hopefully it's helpful for Dennis out there. We can, it's if you want to look at the article, it's in Psychology Today. From July 7th, The Secret to Enjoying Work More. Hopefully it's helpful. So, all right, guys, any other final words of wisdom or thoughts you want to end with? We've expended our wisdom in our talk of sports and the stock market. Okay. Yeah. Well, if you're still listening, really appreciate it. We hope it's helpful. If you're out there listening and you're needing help, you're wanting to talk to us, we are here to help. DennisAdvisors.com. Click the book free consultation button. You talk to one of our friendly advisors today. We'd be happy to talk to you. For now, Jake and Rabih, thanks for being here. Everyone, thanks for listening. That was our 2 cents. Till next time, take care. Bye-bye.